We have about 1 hour, so I intend to talk about 45 minutes or so, leaving 15 minutes or so for questions and answers. When I talk about commercial
let me interrupt you there too. I forgot to mention, when you all have questions, just put them into the question area of your GoToWebinar dashboard as you have the questions, and then we'll compile them after Dr. Liang is done with his remarks and slides, and we'll kind of ask them that way. So when you have a question, write it in the question area, and we'll as you have the question, and we'll get them at the end. Okay, go ahead. Sorry.
And also, Mike has a copy of the presentation. I will go over some of the slides pretty fast. It's not possible for you to read all the numbers on the slides. In case you're interested in more details, feel free to send me an email or send Mike an email, and I'll be happy to share the whole slides with you as well. There is a PowerPoint presentation. And I'm going to touch a little bit on the U.S. economy and the investment market. I'm talking about commercial real estate here, not generally talking about the stock market or fixed income market. And property sectors, that's office, retail, residential, and other sectors. I also have a few slides on regional perspective, East Coast, West Coast, Washington, D.C., San Francisco, things like that. I have a close comment as well. On the U.S. economy side, the first question if you ask me is, do we see a double dip recession? Very clear and answer here is that I do not see it has not happened, nor do I see a double dip recession in the U.S. economy, nor do I see a booming economy in the near future for over the next year or two, because there are just a huge amount of uncertainties involved. Just give a little bit perspective on third-party view that projected GDP growth. And this year, for the first 2 quarters, we ran a first quarter 2% GDP growth, second quarter 1.5, average 1.7%. The projection here you can tell from both blue chip and consensus economics. Those are survey of chief economists of major companies. And they are putting somewhere a little bit above the 2.25% GDP growth this year. We are currently running for the third quarter at a pace north of 2%. So this year, I think those numbers might be a little bit aggressive. Also, we'll probably reach a 2% GDP growth for the overall year. As I said, I do not see a double dip, nor do I see a drastic improvement in economic growth over the next year or two. And my views are very consistent with third-party projection, like Moody's Analytics, for like 22 and 2013, which is a little bit about 2% GDP growth. I personally do not share a view of very strong rebound of 4% GDP growth for 2014 and pretty strong GDP growth for 2015 as well. I have a scenario of pretty healthy growth on 2.5% and for some time to come. And give you a little bit of perspective from a historical perspective. This is a GDP growth for a long period of time. In the 80s and 90s, 80s we have very large increase in labor force. And in the 1990s, if you remember, under President Bill Clinton, there were 30-some million jobs created for his tenure. I'm not sure he helped out, but he can take credit for that. And the last cycle, after recession 2001, we actually have a relatively shorter duration of economic GDP growth. And if you look at since the recovery of 2010, the GDP growth has been very modest. I see that trend around 2% or so, maybe a little bit above the 2.25% for the foreseeable future. Again, I have some outlines later on for reasons why. The recent trends in employment after GDP growth, which is the broadest measure of economic growth in this country, the one indicator that's more important than anything else for commercial real estate is job creation. And we lost approximately 8.8 million jobs in the down cycle of 2008. And the employment started to grow since March of 2010. And since then, we have recovered more than around approximately 3.7 million jobs. And we still have a whole about 5 million jobs or so. And this year, we create a little above 1 million jobs. I still think we can make it to approximately 2 million jobs, maybe a little bit below that. It's a little more healthy job growth environment. It's not strong, not super weak. In order to create 2 million jobs, we need on average 167,000 per month, or if you want to run the number out, 170,000 jobs per month to be created. The job creation in April, May, and June were very, very weak. The most recent number is still a little below 170 as I think about we can create. But the job creation, from my perspective, is accelerating. We I expect fully for next one a number quite a bit above 100,000 jobs to be created by the time the number gets released in early September. So the short answer for the employment growth, we say healthy, steady, but not strong employment growth. And my projection for next year, 2013, still 2 million jobs. I have a 2 million job creation ever since the job creation got started. My projection for last year was 2 million as well. So I have a sort of slow but relatively steady growth if you measure on a yearly basis, not on a quarterly basis. And my most important view, if you at the next slides, we have a job creation since 1990. In the 1990s, we have a very long period of job creation. So those very lots of bars and pretty high bars as well. The job creation cycle starting 2003 was fairly weak. We have only 4 years of positive job creation, but those numbers, the peak level was less than 2.5 jobs per year. And we have a third-party projection, which is the red bar, but those are numbers, the big numbers are a little bit too strong from my perspective, but I do agree we have a prolonged period of job expansion. I expect quite a few years of positive bars. Sometimes it'll be higher, sometimes it'll be lower, but averaging around somewhere the 2 and 2.25 jobs per year on average. The projection from Moody's Analytics direction is correct, but magnitude is a little too strong from my perspective. The short answer is that in terms of duration, I expect a period of job creation on par longer than the one we saw in the 1992 expansion in terms of employment growth. And the retail sales, if you look at the bars on the right, which is the sequential month-over-month retail sales, we have 3 months of negative retail sales growth. The most recent number released was about 0.8%. Those not annualized number, by the way, just recently released. Just for information that once historically 3 or 4 quarters of negative retail sales growth will often indicate a recession to come. So people were very worried about those numbers until the most recent number. Again, I don't see signs of double-dip recession at this moment. As a matter of fact, all indicators are pointing to a stronger growth for the second quarter than the first quarter. So the next one is the good news. You may ask me why I feel a little bit more positive. The housing downturn started. The economic downturn in 2008 started with the housing market. And housing market, from my perspective, in all signs point to me reached the bottom at the beginning of this year. We are on our way for recovery in terms of construction activities, in terms of sales activities, and most importantly, in terms of pricing trend. If you look at a month-over-month sequential movement, which is the blue line, we are in the positive territory for 2 months in a row. Doesn't mean 1 month we couldn't get into negative territory, but generally speaking, I believe this cycle of a housing market pricing correction is over. Going forward, it's a matter of how strong the recovery can be. And that is very important because housing market is permeates across the economy, and going forward, it's going to contribute quite significantly to economic growth, GDP growth going forward, starting from such a low base. The next one is the housing market. The other one is over-leverage in consumers. And if you look at the blue area, which is the debt service burden, that's the debt service of consumers as a share of a disposable income. That's a long history dating back to 1980, by the way. We are not at the lowest point in history, but we are pretty much at a very low point of the cycle, which means that consumer debt burden is quite manageable. It's actually very light from a historical perspective. 2/3 because of very low interest environment, 1/3 because of drop in absolute amount of debt outstanding, which is the blue line, which is not an absolute, but the debt as a share of GDP is coming down quite a bit as well. So consumers, from my perspective, have repaired their balance sheets. That is a plus as well. So you have housing, consumers, and corporate profits. Corporate profits, both red line, which is the share of GDP, the blue area is the absolute dollar amount. You don't have to read the numbers. You can tell they are at a record territory since 1978. Actually, going back to a longer period of time, I have never seen such a higher GDP ratio before. So corporations are flush with cash profits, and eventually have to do something about it. Either they invest the money or they have to give the money back to shareholders in the form of dividend payments or stock buybacks. So corporations are doing very well. And actually the stock market, the fear index in the stock market, which I don't have a slide, is not at a record low, but it's very, very low by historical norm. So the fear has receded for the stock market. The bond market premiums have come down, and the junk bond activities are at or near record level. So the overall risk-taking in the economy is going up, not coming down. So as a result, I see second half this year to be better than the first half of this year in terms of overall economic performance. But again, I'm not seeing a super strong rebound. I'm just talking about instead of 1.7% first half GDP growth, we probably do north of 2% for the second half. Average a little bit about 2% as the consensus has projected. Okay. The next one I'm talking about the private real estate market. Okay. The first one is the real estate returns, and we have 3 years recovery, double-digit returns, 2010, 2011, and 2012. In the private market, the return indexes start to turn positive in terms of appreciation in the second quarter of 2010. And this year, we have done approximately 5.4%. One index is 5.5, the other one is 5.3%. And I'm projecting approximately 10% for both the liquid property index and liquid fund index of open-ended diversified core equity fund. For those who are not familiar with, liquid property index is pure all the properties that contribute by members to the National Council of Real Estate Investment Fiduciaries. The open-ended diversified core equity fund index currently has 18 open-ended commingled real estate funds that is its universe, and it's a fund performance has a little bit leverage involved. It also has a little bit cash drag, and it's also appraised every quarter. So both indexes are relevant. So this year, we probably reach a double-digit return for both indexes, and going forward, the returns will be normalized. I do not expect a double-digit return next year. Somewhere around 8 to 9%, for example, is what I'm projecting for returns for next year. And year after that will further come down a little bit. In this cycle, on average, the proper normalized return is somewhere around 7%. So we're still above what the market should deliver on average as we underwrite our deals. So this year around 10%, next year further down into high single digits. And then liquid, that's the cap rates of all the properties. One is equity weighted, one is value weighted. Value weighted is more indicative of the overall market. Equity weighted is more indicative of a typical property in the index. A typical property is trading at 6% a cap rate, and the market overall is value the properties at 5.6% cap rate. Of course, the cap rates are coming down. Besides, the fundamentals are stabilizing. Most important, interest rates are low, and mortgage rates are also at a historical low point as well. And cap rates do compete with cash, compete with capital, compete for capital with other investment vehicles such as stocks, fixed income as well. And when the interest rate is so low, and then there's no way the properties can trade at a very high cap rates because it will be too attractive to investors. And if you look at the different sectors, those are equally weighted, by the way. It's more indicative of typical property. And for apartment, currently it's about 5.4%. Overall, it's quite indicative. And for nationwide trend for industrial, it's about 6%. For office is 5.9%. Office industrial very close to 6% value on average. Retail is about 6.5% overall of the cap rates. And the next one, those are values based on appraisal. So here the next slide on page 13 is running the pricing trends we see based on what in the transactions market. On the peak level, we have an index of 100. The downturn on average, the price drop of commercial real estate, and those are not appraisal based, those are based on transaction based index, was approximately 30%. And my personal estimate, the value drop was somewhere between 35 to 45% in the downturn, but 38, 39% was very typical. We're already recovered 53% so far. but 53% is bigger than 38%, but we're not recovered to the top yet because 53% measure over space that's 38% lower than 100, which is the top of the base for the drop of 38%. We're approximately 6% below the peak pricing level we have achieved in the previous cycle, and that 6% is very, very low percentage. So we're pretty close to historical high level price per square foot or price per unit basis in aggregate. And the pricing trends by sector, again, this is on transactions price. This is not pricing based on appraisals in the National Council Real Estate Investment Fiduciaries database, for example. And if you look at the two sectors that surpass the pricing level is residential apartments and in malls. Apartments is the strongest sector at this moment. Okay, vacancy rate is very low, and income is going through double digit. I'm talking about 10% more for professional managed apartments nationwide on average. In certain markets, not going way beyond 15% per year at this moment. As a result, apartment has recovered every direction: pricing, in income, and in occupancy. All surpassed the previous peak. The next one is shopping malls, has surpassed the previous peak in pricing as well. The strip center is a little bit below. If you look at the line, if you read carefully, it's probably around 7% below. And the industrial is approximately about 14% below, and office is about 17% below. And by the way, hotels approximately about 18% below the previous peak. Just give you a little bit sense. And specifically for the bigger markets in Manhattan, for example, the Class A office building in Manhattan is probably about 8% to 10% below the historical peak. Class B plus type of buildings, one tier below, it's probably around 18 to 20% below the peak level achieved for the Manhattan office market, for example. Just give a little bit perspective. And the next one, so besides appraisal, return environment, transactions pricing, the next one is the volume. When you look at the market, first you look at price, the second one look at transactions volume, the third one you look at rotation between sectors and among economic geographies. So in terms of transaction volume, I call the market is normalized, and the transaction volume is not too high, not too low. Last year the volume was a little bit higher to the volume we saw in 2004. The overall economic condition was very similar for 2011 versus 2004. But pricing point was a little bit higher on the space terms in terms of square footage and units transacted. In 2011 was slightly below, but roughly the same, was slightly below 2004. In dollar amount is higher because the pricing point in 2011 was higher than the pricing point in 2004. This year, and you saw the right bar here, we are roughly on par with the last year as we year to today. I think we are going a little bit higher this year versus 2011 by the time it is over. I am not keeping project numbers to go higher year by year as we saw in 2004, 2005, 2006, and 2007 because we don't have the same capital market conditions as they were in those periods because of very sharp drop in cap rates. So as a result, going forward for like several years, I call the trading volume range bound between somewhere 200 and 300 billion as calculated by Real Capital Analytics, by the way, somewhere between 200 and 300 billion per year, range bound going forward for like several years to come. We are in this range, and that's why I call it a normalized transactions market. And the next one is the income growth. That's very important. That's the most important indicator in the space market, and we are currently running about say 4.5% or so in terms of income growth on a 21-year basis. And the bulk of that income growth, by the way, came from residential, averaging 10%. The rest of the sectors, as office, industrial, retail, for example, hotel is a very small segment of index. That's why the hotel numbers are excluded. And they were running approximately 2 and 2.5% for the other three sectors and averaging approximately 2.5% of income growth. And this income growth most likely will stay roughly at 5% for the foreseeable future. First, income for growth for apartment will continue to be strong, but income for growth for the sectors like office, for example, is a very slow-moving average of historical rents. So really, the individual rents can move up very fast in one single year by 10, 15, 20, 25%, but income moves much slower because they have lots of historical in-place rents in place. So I'll say we're probably running somewhere between around 5 or 6% for several more years in this cycle, very similar to the period we saw in 2006 through 2008. And at this point, I do not see a peak level as we saw in 2000, 2001 of 12% income growth over the next 2 or 3 years on a yearly basis. The next one is the space market cycle. This is a diagram to indicate the vertical axis is transactions volume, the other one is time. The U.S. property market goes through a very predictable cycle. It runs approximately 10 to 12 years. Sometimes it could be as short as 8 years. We are about 3 years into this cycle. Okay? And I call credit-driven. That's when the fundamentals are very weak. We're in a recessionary environment. Nobody wants to invest in real estate for the sake of real estate. They invest in the best buildings, long-term leases. They view real estate as fixed income substitute. So only a quarter of market transacts in that environment. And those are basically, they treat them as like credit-driven market, like credit is a term in the fixed income market. It's called credit-driven. So as the recession is over, jobs to be created, occupancy start to go up, rents start to go up, and investors start to take occupancy risk. They invest in segment real estate that's not purely credit-driven. They would like to take some risk. They would like to underwrite some rent increases. That is a phase we call fundamentals driven. We are into this market. 2011 was the first year. We are into the second year into this phase of fundamentals driven market. And then the capital driven is very often fundamentals are good, returns are good, everybody's happy, and lots of capital gets allocated from chief investment officers into real estate. Guess what is we beat the price out beyond the fundamentals, and very often there is an overall economic recession, and we run over a cliff, and there's a fear-driven, and uncertainty is great. Nobody wants to transact. Nobody knows where the bottom is. That was 2009, by the way, in the last cycle. So we have several more years before we can reach the top of this property market cycle. And so this is a very good diagram to indicate the different phases of the property market. And that one, by the way, has a stronger correlation to transactions volume, has a lower correlation in return. Actual return in this cycle already peaked over the last 2 years, but the transaction volume has not reached the highest level in this cycle yet. The next one, I'm talking about sector perspectives and fundamentals as well. Just give a sense the overall stress in the space market. If you look at the overall vacancy rate, that's the average of all property sectors in the market, office, retail, apartments, and industrial properties as well. The stress level in this cycle was a little bit more severe than the one we saw in 2003. Was the most stressful moment in terms of space market. And the office market is as stressful as the one we saw in 2003. That was a major downturn in the office market triggered by the collapsing of the tech bubble or the bursting of the technology bubble in 2000. But having said that is that we have a very minor recession in apartment, in retail, in the warehouse market in 2001 recession. We have a pretty serious recession in those sectors starting 2008 as well. That's why the overall space market in this cycle is more stressful than the market we saw in 2003. But the sectors, those are actual numbers reported. Those are not model driven. Actual numbers for apartment, if you look at apartment vacancies at or near record low levels, we have seen the last time we saw such a low vacancy was in 94, 95 era. So the apartment market is prime for new construction. Occupancy is record high, not record high, but near record high. Rent growth is very strong. NOI growth is double digit. In stronger markets, 15% more. And so this is a sector that new construction has already started. Industrial sector went down, is still very high, far more stressful for the industrial market than the one we saw in 2003. And for retail, is the very high low, actually pretty much the highest level I've seen for a long period of time. It's gradually coming down. The office has followed a very predictable path of coming down in terms of vacancy rate, gradually as jobs are being created. So that's a very good indicator of the overall cycle of the four property sectors. And the other sector, which is we hear very often, is the hotel. And if you look at hotel, has a sharp rebound in occupancy. This is an over seasonally adjusted quarterly occupancy, and has a very sharp occupancy rebound. And going forward, the rebound in occupancy will be slower because occupancy is already, from a historical perspective, very healthy. It's not a stress level. Going forward, the operators will focus more on the room rate increase. So we'll see probably around 5 or 6% overall RevPAR growth, revenue per available room growth in that range for several years to come. I actually agree with the overall direction projection. By the time the cycle is over, we probably reach occupancy at a near the historical top we ever achieved in the hotel market. Having said that, this is the second sector in the future we'll see new construction. Apartment is the first sector, as I mentioned before. And the next one, the construction starts, and this is just on a trailing 12-month basis, so it's a little bit back. Every time a moving average, this is a moving sum. Is sort of when the numbers going up, is a little behind. Currently, on an annualized basis, the most recent number is quite bigger than the number you pointed out here before. The permitting activities this time will reach or go beyond the peak level we saw 2007. The space market condition for rental apartment is too tight, unless something dramatic happens in the single-family housing market, where home ownership rate will go up quite a bit from today's level, and the demand for rental apartment will remain very strong, and the market just not have enough space units to support. As a result, is that I do see by 2013, 14, and 15, the permitting activities will continue to go up. I see at a peak level 2014, for example, or maybe even early 2015, the level will reach a surpassed level we saw in 2006 in terms of construction activity, the permitting activities in the rental apartment sector. And the next one is the return. The biggest sector, commercial real estate, is office. It is the most visible sector, and when people talk about commercial real estate, very often they talk about office. The chart, what you see here, is not absolute return. It's the relative return of office versus national average of all properties overall. When the area is in a positive territory, it means office outperforming the national average of all real estate, commercial real estate, of all sectors. When the area is in the negative territory, it means office is underperforming. The underperforming territory, like in 2003, for example, as we mentioned, office went a major downturn in terms of space market as a result of bursting of technology bubble ending in 2001. Other sectors went through a very minor recession. As a result, office severely underperformed in the downturn of 2001 and the years after the downturn, of course. Of course, the office also boomed because when the jobs created, office is a bigger beta sector. Rent went up in 2007 and portion in 2008, by the way, and the 2006 as well. So office outperformed, and unfortunately, office went through another major downturn. It has underperformed since 2009 again in terms of going forward. Actually, in the near future, office will continue outperform. Another 2 years from today, office is going to move up. It's going to significantly outperform again of the national average in terms of overall return performance. Residential sector, look at the most recent one. This sector was the strongest in terms of fundamentals, the first sector recovered even ahead of the hotel sector. As a result, is running significantly outperform the national average of all sectors of commercial real estate. Okay. And of course, at that period, office underperformed because they have reform relevant to office, because office is the biggest sector. And if you look at the 2007, 2008, when office was booming, apartment was relatively weak. So they rotate. And for retail, for example, in 2009, 2010, when office went through a major downturn, and the retail is relatively healthy in terms of cash flows, because there are lots of in-place rents. As a result, it was doing pretty well. Okay. And the next one is the industrial. And the industrial markets, the skills of all those charts, by the way, in similar. Industrial, we call it smaller beta, is a baby sector of the office, is a baby office sector. It doesn't boom as much, it doesn't underperform as much, but nevertheless, it has a beta closest to 1 in terms of industrial. By the way, the office market, industrial market is driven mostly by the warehouse market, which is about 80% of the overall industrial market. Okay. The next one is they have a regional perspective. Just the market is not always created equal. If you look at the major investment markets in the United States, I list about 28 of them. And the Los Angeles is about 12.2%. The top 5 markets represent almost 50%. Historical general is 50 to 55%, just give a little bit perspective. The top 10 markets is 71%, okay? And the top 20 markets is about 90%. So for all practical purposes, those 20 to 25 markets are the most important institutional market in this country. Okay. And to give you a reasonable perspective on the relative performance, on vertical axis is the most recent quarter, the second quarter performance relative to the national average. If it's above the horizontal line 0, means it's outperforming in most recent quarter. If it's below, it means underperforming. The horizontal axis is the last 1 year return. So on the right side, the markets are outperforming over the last 1 year. On the left side, those markets are underperforming over last year. So of course, on the top right quadrant, that's where the market is doing most the best. On top of that market is San Francisco. Of course, you know why. Because it's running the technology driven with the social media, Facebook, and others that's going on the Silicon Valley. San Francisco is running booming. And Seattle is doing pretty well. Denver is the energy sector as well. And on the lower left side, and the market I would like to highlight is Washington, D.C. Historically, Washington, D.C. has been a very strong performing market. And recently it's underperforming because of what's going on with the government, the fiscal cliff, and also a little bit of Washington, D.C. is at a more advanced in terms of construction for apartment homes as well. But overall is the headwind that Washington, D.C. is facing because the potential downsizing or slower growth of the federal government in the Washington, D.C. area, that's the District of Columbia, and Northern Virginia and suburban Maryland, for example. So that's a pretty good indicative of relative performance. On one end, among bigger markets, San Francisco is a superstar. On the other side, relatively, among bigger markets, Washington, D.C. is weak at this moment. The next one is give a sense, office is the bellwether sector. Just give a sense the relative strengths of different markets. On the horizontal side, the current vacancy, that's the vacancy of this office market as of end of second quarter. The vertical line indicate is the forecast vacancy rate by the end of 2016. Okay. Of course, we have a dashed line just to indicate equal distance from both sides. The markets in New York, San Francisco, and Boston, those are markets, and even Washington, D.C. have relative low vacancy rates. The markets like Phoenix, Dallas, West Palm Beach, Atlanta, Tampa, for example, and Miami, relatively have high vacancy rates as of today. But the vertical distance, for example, the dropping down is an indicator. Phoenix expect, for example, on the vertical side, the dot versus the dashed line, that's the vertical distance, how much you expect Phoenix to drop in vacancy rate, is to expect have a huge decline in vacancy rate for the Phoenix market going forward, and the Dallas as well. But at the same time, we expect a smaller drop in vacancy for the San Francisco area. If for any reason the market is already very, very tight, it's very difficult for a very tight market to see a big drop in vacancy rate. And the demand growth will be a little bit constrained, and also supply will come a little bit. The office development cycle has not got started, but the first market will see significant new development. In the small supply-constrained market will be in San Francisco. Again, the cycle has not started. In the suburban-driven market, it will be in Houston. The market does have significant delivery for office space in the near future. Is also New York City, but New York City is more politically driven because the rebuild of the former World Trade Center. We have 10 million square feet of space approximately coming up in the near future in New York City. But that is not a strong indication of construction cycle for the New York City, as I mentioned, because of the political and historical reasons, the rebuild of the World Trade Center. And the other markets like San Diego, but not very close, not far away from the U.S. overall, for example, you see a very significant drop. You see a very significant drop in Miami and very significant drop in Raleigh-Durham as well. So those are the markets probably present both core investment opportunities and some value-added investments in those markets. So there's the vacancy level and also the movement of the vacancy, both decides how strong the rental growth will be going forward. Okay. The next one, as in a residential apartment, we already at a record low or near record low vacancy rate. Going forward, if anything, we'll see a flat or slightly increase in vacancy rate going forward. You have a 5-year view for the residential sector. For office, retail, industrial, and hotels, the vacancy will be coming down. And it's a classic recovery of the space market rather than for the residential sector. This will be as predictable as we saw in the last cycle. And so the office market put here is a classic directionally generally in agreement with what has been presented over this cycle. I actually believe the drop in vacancy might be a little bit faster than what has been presented by third-party forecasters, CBRE econometric advisors. So overall for office, retail, industrial, residential, hotel, we see a very classic recovery in terms of occupancy, classic drop in terms of vacancy rate going forward. Again, the residential sector follows a different trend. Okay. Overall, that's my summary. I have 4 points. We have huge amount of uncertainty in the economy. Let's not discount it. First of all, we have the never-ending European debt crisis. And we also, China and Asia growth is decelerating. Actually, it's decelerating pretty fast. And emerging markets growth overall is decelerating as well. As a matter of yesterday, Brazil announced a big stimulus package for the Brazilian economy. In the U.S. politics, we have a presidential election. We also have a fiscal cliff in terms of taxes, in terms of budget deficit spending as well. Those are huge amount of uncertainties, and consumer confidence is still very, very low. It's not at a historical low point, but it is still very low relative to a historical norm. And if you pay attention to the recent news, the student loan balance has really skyrocketed over the last 3 years or so. And those are all huge amount of uncertainties in the U.S. economy. Having said that, there are lots of positive signs, and some people use the hopium. I think it's better than hopium. They are real. And first of all, for business are flush with cash, okay, and with profits. Okay, and the economy is not in a pool of liquidity, as I written down here. It is an ocean of liquidity. If historically, eventually, that liquidity is going to translate into some form of demand growth for investments and for consumption. And the housing market, as I mentioned, has reached the bottom. And I'm fairly positive that, and the housing market will contribute significantly to economic growth for like many years to come, many years beyond like 3 or 4, 5 years. And also consumers are in pretty good shape, and the credit for the residential sector for housing buying is still constrained. And but having said that, is that if you want to buy a new car, you pretty much, no matter what the credit you're having today, you can't get a car loan as of today. So credit is flowing into other sectors of the economy as well. In the market, in the stock market, the capital markets overall, as I mentioned, the fear index is not a historical lower point. It's very, very low by historical standard, which indicates that the stock market confidence is high. And the bond market is very active. In corporate bond market, particularly high yield market is super active, and the premium and the yields are coming down at historical low point, which really is a very strong indicator of increased appetite for risk in the overall economy. Okay, and U.S. is benefiting as a safe haven as what's going on is growth in emerging markets slowing. European markets are in a recession at this moment overall. Okay, UK is in recession, Italy is in recession, Spain is in a recession, and France is on the borderline recession. Germany is still technically not in a recession, but over Europe is in a recession. But U.S. benefit as a safe haven in the overall the capital flight. The fundamentals are improving. The honest supply growth is significant. Is the residential sector is going up as well. Any other sector, we have very limited supply growth going forward. The vacancies are coming down. I see a normalized market in terms of transactions volume, in terms of interest in both the gateway markets versus secondary markets, more normalized in terms of the returns going forward for next year will be single digits in terms of transactions volume, will be in a normalized range. As I mentioned, it's not too strong, not too weak. So overall, I see modest economic growth, healthy transactions volume, and improving fundamentals and competitive returns for the real estate market going forward. Mike, I stop here. That's the overall presentation I have.
All right, well, great. Well, thank you. We've got some questions here, but I want to encourage everybody to, if you have more questions, submit them. We'll get started here in no particular order. First question, Dr. Liang says, well, let me find it here. The cap rates seem very low. Where did the data come from? And I can't go back to that slide, so I don't remember.
Yeah, I have it. The cap rates on the slides I'm talking about, that is the slide. The other one, this is the slide based on all the properties, but more than $300 billion worth of properties that the investment managers and investors like us, like for example CalPERS, who submitted to the we call it Trade Association National Council of Real Estate Investment Fiduciaries. So it's basically the current quarter income divided by valuation. Of course, the income is annualized, and that's the average. The reason is low, first and foremost, is because 80% because of very low yield in fixed income market, which drag down interest, drag down the yield, and also the property market stabilizing, and there's expected growth of income as well.
Okay, great. Next question. What percentage of the current unemployment do you think is contributed to by the inactivity in the construction industry?
The bulk, probably about, again, this I'm talking about over my common sense estimate, from no more than 1.5%. Okay. Actually, the bulk of the employment base in this country is service-oriented. And even with the recovery of the construction jobs, we're not going back to the peak level we saw because we don't have the overall, the level of construction activities. So I'll say 1.5% will be my guesstimate.
Well, so not as significant as you might think.
Yeah.
Slide number 28. This is from somebody up in the northern part of the country, I guess. Why is Minneapolis showing such a huge drop there in potential vacancy?
I want to mention this. This is a third-party projection, and it's also model driven. And my views, I will not see that huge a drop. The investment markets generally are bifurcated. It's a U-shaped market from Boston to Miami, then from Miami to Texas to San Diego, and then from San Diego, excuse me, to Seattle, with a dot is Chicago. So for Minneapolis, my personal view, probably not having this kind of drop, but this is a third-party forecast. I will be very surprised to see that for Minneapolis going forward.
So we had a brokerage company up in that area hoping that something wonderful was going to happen, I think. In slide number 27, total returns relative to MPI. Do the cities that are below the horizontal line and left of the vertical line necessarily represent opportunity markets?
No, actually, it's better way to indicate is actually there are some weak. Again, that is relative to the nation. Those are relative weaker markets. Like give example, Kansas City, Columbus, and Memphis. Those are generally the Midwestern markets. Typically, don't perform very well historically and currently. The markets like Orlando, for example, Tampa, because the housing market in those places, the overall employment base, the overall economic recovery is a little bit behind the national average. They have a little bit hangover in terms of vacancy rate in both the rental market for apartments and also the overall office market. For example, that's why they're a little bit weak. The markets on the top and right, besides San Francisco, Seattle are tech-driven. Denver will be energy-driven. Of course, we have a Boston on that one as well. Chicago is more in the middle point. So I would say it's more indicative what's going on over short term relative weakness. In terms of where to bet over longer term, you need to go beyond a little bit just on this page. It's just like more taking a photo of what's going on. If someone were sick, you will see from that picture that person's sick in this moment. Doesn't mean that person couldn't recover, or possibly the person could go through a very prolonged period of chronic sickness as well. So this is one picture, just what's going on over last quarter and last year.
Does that slide usually look very similar to that? I mean, is Kansas City, Columbus, Memphis, are they always underperforming relative to?
80% of the time, the Midwestern markets, like for example, Indianapolis is not there, St. Louis is not there, they are generally underperforming. They're 20% time when the national economy is in serious crisis, like in 2009, those markets on a relative basis overperforming. We call those a very low beta market and very low return market. Low beta markets, when the market's booming, they underperform. When the market really tanks, they outperform because they drop less. And I would say 20% or 15% time they outperform, but the super majority time they do underperform.
Okay. There's a question here, but I think you kind of got to it. Are regional trends also available? For example, how the Northeast compares to the national averages? And I think that question was submitted a little bit earlier, but in some of your later discussion and some of your later slides, you had some of those, like the one you have here, regional information available. So I think you got to that. Do you have anything more to say about regional differences?
Yeah, the only comment I have, the biggest markets we call the geographic region, we have four. The Northeast, the West, South, and the Midwest. Midwest represent 10% of overall market, and that's anywhere from Chicago all the way down to Memphis. And so and all the markets in between. Salt Lake City actually goes to mountain states. And then the South, the East and West represent about 1/3 of overall investment market each. The residual go to the third largest market after East and West, which is the Southern Growth Belt market. Back to you, Mike.
says, talk a little bit more, if you would, about the student loan situation and how big an impact that may potentially have on the markets in the future.
Yes, I will read the student loan from have two tiers of views. Number one is bad. It indicates that consumers are a little bit weak in terms of their buying power because lots of people are unemployed. That's on the negative side of the view, and it is very significant. It's $1 trillion in size. And on the positive side is that very often during the recession, this occurred in the past as well, people go back to schools. Okay, when you don't have a job, don't have a job, you're 35 years old, and you may as well go somewhere, have a master's degree or have a bachelor's degree, for example. So more people going back to technical schools, to graduate schools, to undergraduate schools as well, and very often they do borrow money. So it's an indication of the number of people I employ. It's also indication of the number of people going back to school. But overall, I do view that one, the amount of increase is unprecedented among the numbers I've seen before. It is of concern. So overall, it will weigh negatively on the economy from my perspective. But again, I do read a little bit silver line in the overall increase, because once they get a degree, they overall they will become a little bit more productive going forward. So that's the silver line I'm reading from the increase in the student loan balance. But overall, it's very big indeed relative to the historical norm.
Okay, this came in as you were talking about student loans. I'll try to summarize it a little bit. Basically, the question is, student loans are not part of consumer debt. You had a slide that talked about consumer debt being near historical lows right now. Their question has to do with, do you think that that people are not borrowing money on their credit cards to pay for college, or going to student loans, and how does that all fit in?
Actually, the chart is the amount of debt is not at a record level. It's decelerating. It's still very, very high in terms of as a share of GDP. If you look at the line 8 on the screen, it's coming down, but it's still much higher than
the debt service burden is low because of interest rates.
It's the debt service burden because of very low interest rates. The drop in debt mostly because of drop in mortgage outstanding. Some of them because of the payoff, some of them because of foreclosure. Some of them they just walk away from some of the mortgage debt. And the credit loan balance recently started to go up. But overall, there was a significant drop in credit card balances, and also in the loans of car loans as well. If you remember, the car sales was quite depressed for several years in a row as well. So overall debt is still high in absolute amount relative to GDP, but if you take into consideration interest rate, the debt service burden is very, very low for consumers.
Okay, let's try one more here. Why are businesses holding on to cash so tightly, and what will entice them to reinvest in the market and in creating jobs?
This one, I have a politically correct answer. I have a politically incorrect answer. The politically correct answer is that we do have, I will use the words unprecedented uncertainty, because when I was thinking about 2007, 2008, we have more uncertainty. But nevertheless, we indeed have huge uncertainty in domestic economy and politics, and international economy and politics as well. So as you have huge amount of uncertainty, guess what? Naturally, for CEOs, the people in position of power, they pull back. They need clarity. So that's the politically correct answer. The politically incorrect answer is that CEOs, just like us, they are human beings. They were shell-shocked in the downturn of 2009. Many companies almost couldn't survive in the 2009 downturn. Just like when we were underwater for 5 minutes, we as human beings, we die. And if you came back, you become a different person. You managed to survive. So they were shell-shocked, and also they sit on the top floor of the office buildings. And the problem, I'm not sure they read even as fast information as the average you on the street as well. Other than a few CEOs who are truly outstanding, the short answer is that they are still in a surviving mode for many CEOs. As I talk to the decision makers in places like real estate roundtable, actually I call the two groups of people are more negative than average people in the country. One is people in position of power. CEOs is a good example. The other is the lower class. People either have very lousy jobs or they are out of a job. They have very low views. The middle class actually have better view of the confidence and view of the economy than either the very high people in terms of position of power, or the people are very unfortunate, have very poor jobs in terms of pay, or they are unfortunate out of job. So until the CEOs have increase their confidence, it's very difficult for them to invest their money. And again, they are still in the trenches, and to make sure that another downturn in 2008, and they could survive again. The odds is that history repeats itself, and history never repeats itself exactly. And we're not going to see a downturn in 2008 the same way anytime soon.
All right, let's see how you answer this one. Do you think that the outcome of the November elections will make any difference in your projections?
It's very little in the sense that regardless whether or not Democrats or whatever the parties, we even have third parties get elected, for example, they face the same economic issue, which means they basically need to close the budget deficit a little bit, and the debt level is at a level that we could not sustain going forward. The reason we are sustaining the debt load because the interest rate is so low. And we have the same amount of debt as a share percent of GDP in this country versus Spain. And Spain is in serious trouble because Spain is paying an interest rate almost 5 times higher than what we are paying as of today. So as a result, I see very little difference between Republicans or Democrats in power in the White House going forward. There will be policy differences, but they will all have to confront the same exact economic issue. As the problem have to figure out whether increasing taxes is through a marginal rate or through increasing effective rate. Those are different policies, and they probably have to cut expenditure somewhat. They probably have to figure out a way to take care of the military expenditures and or Medicare, Medicaid as well. So there are no choices. A very little impact on the overall economic growth in this country from my perspective.
Okay, we've got a few more questions, but it's 1 o'clock, so let me just ask one more real quick, and then maybe if it's okay, I'll send you an email with the others, and you can just, you respond to them, and I'll send them to everybody. The last one here is what is the major source of financing for commercial real estate right now?
It's everywhere. Okay, it is the insurance companies. They have record volume of origination, and this year probably more than $50 billion. They are going after deals left, right. It might be a surprise from banks. Banks are coming back to construction, banks for existing financing. It is from CMBS. It's still relatively lower volume. The CMBS volume this year will be higher than last year, still below what I consider a par volume of $80 billion a year. So we probably make it say 40-something, maybe $50 billion a year. But it's going up year on year, and it's from foreign banks, like Chinese banks are very active in the lending market in the U.S. The Canadian banks are very active in the U.S., not the European banks, by the way. But the foreign banks are active in the U.S. market. It is also from foreign investors. So it's a whole host. There's no shortage, either equity capital or debt capital for commercial real estate at this moment, with one exception. For certain developments, like for office, for example, banks are still hesitant in financing new developments in certain sectors at this moment. But in terms of any other financing, there's really no shortage of money at this moment.
Well, great. Well, we've kept you 2 minutes overtime, so you'll have to send me a bill. I want to thank you, Dr. Liang, for your expertise, and everybody for your attention and your questions. I want to welcome the PREI people, and hopefully you'll join us quarterly when we do this, and we look forward to having you as part of the group as well. So with that, I'll tell everyone to have a great afternoon if you're on the East Coast, great rest of the morning if you're over on the West Coast, and we'll look forward to talking to everybody. Any unanswered questions, I'll email to Dr. Leong, and if he has the time to answer them back, I'll send them out to you, and we'll go from there. We said earlier that these sessions are recorded, and Dr. Leong's notes and the recorded session will be in the training library of Orion, so you can go there anytime you want and revisit any of this that you want to, any time of the day or night. So again, thank you, Doctor, very much. You have a great day, and the rest of you, we look forward to talking to you down the